Okay, so now we're entering the adjustment phase, and it's time to talk about why we need to make adjustments in the first place. With financial accounting, we're hoping to capture all of our revenues based on what generally accepted accounting principles say. And as we make our transactions during the month, we are reflecting those transactions pretty much on the cash basis. And the cash basis, that's not our rule of thumb for recording revenues and expenses. We want to follow what GAAP says about revenues and expenses. And GAAP says that we need to recognize revenue whenever we've satisfied a performance obligation. So most of the time, this means that for revenues, GAAP says we have a revenue whenever we've performed a service or we've delivered goods. On the expense side, GAAP says that we want to record our expenses whenever they make their contribution to revenue. So sometimes we refer to the expense rule for GAAP as the matching rule. We want to match up our expenses along with the revenues in the same period that they help generate. So, in thinking about making adjustments, what we're going to be doing with every single transaction is that we are going to be recognizing either a revenue or expense. So, as we approach whatever kind of adjustment it is, as we approach that, it's always going to be, is this a revenue or is this an expense? We are never, ever, ever going to be involving the cash account when it comes to an adjustment. So that's another thing to keep in mind. Cash will never be our debit or our credit. And when we're finished with the adjustment phase, what we will have done is adjusted our cash basis books to reflect the accrual basis, which is exactly what GAAP is hoping to do.